All right, guys, welcome to my channel. Welcome back if you've been with me for a little while. We're going to go into the stock market, cover some things that I've been talking about for a while, and cover what happened this last week. I know there's lots of channels that are kind of onto it, but I want to kind of call out what I was talking about, you know, a couple weeks back, and that is this chart right here. So I want to show you, I've kind of hidden some of my horizontal trend lines, and I just want to show you this pattern that we have in place right now. And this is a bearish rising wedge. This is the pattern I've continued to say, watch this pattern. This pattern is forming. We're continuing to firm up in the pattern, and we continued. When we broke above the pattern right here, this is a couple videos back. This is where I said, look, this looks like a bull trap. This looks very similar to a lot of stocks. And I pointed to Walmart and I said, look, this looks like exactly like Walmart. And I'm going to flip over to the Walmart pattern here real quick. Really, I'm just trying to reinforce patterns, not so much that it's Walmart or the fundamentals or anything behind any of it. I just want to reinforce trading patterns. Patterns exist and repeat because they basically capture human psychology. That's basically it. You capture greed, you know, they show greed, they show fear. When you pop above a bearish pattern and everything looks great and everybody's happy, that's capturing greed, and people are, they become complacent. And so that's really all it is these patterns form because humans are humans and we react emotionally. We have the same emotions. No matter who we are, we feel fear, we feel greed, we feel the same emotions for the most part. And so these patterns form up. And yeah, I know a lot of trading's done by algos, but they're managed by humans. All right. So if the algos are running throughout the day and racking up losses, the humans that are managing those feel the emotions and they tweak the algos. So there's still a human behind the science and behind the brain of the algos. So it still comes down to human psychology. So look, here's the bearish rising wedge, and here's the bullish breakout higher above a bearish pattern. So when you see a bearish rising wedge, think to yourself, okay, this is a bearish pattern. This is bearish. I mean, yes, it is bullish in the short term. When you're within the wedge, it's bullish. If you're just riding the final, you know, little bit, but you should recognize that when you start to get to the end of a bearish rising wedge, the risk reward to continue to rise is very low. And at that point, you should be looking for opportunities for a reversal and you know, potentially to reverse the pattern. And that's how I trade. So if you don't recognize the pattern and you don't see it, then all you see is rising prices. And that's what I get a lot of the comments is people are just saying stocks are going up, you know, you're a clown. I get called a lot of names, but the reality is that I'm looking at the pattern, I'm looking at the risk reward. I see that we're at the end of a pattern, and the risk, yeah, there might be a 2% upside and a 30% downside. And so it's like, I don't even want to play games with trying to get that 2% upside. I want to look for capturing the next big move, which is high probability to the downside. When I say I have to speak in probabilities because nothing's for sure. So it's all about kind of just putting the probabilities in your favor and then putting your wager down. A lot like gambling at a casino, where, you know, if you're playing blackjack or something and you have a high probability of making a winning hand, then you want to make sure you put your money down. So it's like card counting. That's basically how I treat this here. So this is basically the bearish pattern. Let me flip over to this Walmart chart. It might look a little messy. I haven't cleaned this one up, but going back on the daily chart, look, same pattern rolling out. Here's a bearish rising wedge. All right, you've got lots of reactions along the wedge on the bottom here, and you can see we verify that wedge right up in here. See the overshoot, but it doesn't close above this, so it overshoots and closes back within. So that, it's all about the close. The close is key. And so you held that. Lots of things. Now here's your overshoot. Here's your greed, kind of your greed state of this stock. When it shot up here, everybody in this area was greedy, basically. They just thought this thing was going to continue to go higher it broke out of the bearish pattern. It was going to go higher and instantly rejected. And rejections a lot of the time, or bull traps, are set or sprung with a gap down. So we saw that right here, gap down, and we traded down there. Now they did get an opportunity. If you were a bull and you were trapped, this was your only exit that you've had so far. And it was earnings day for Walmart. They popped the market. They popped it on some sort of earnings, basically beat like horrible expectations, and they just came in a little bit better than horrible. Okay, that's fine. So they popped it. That was your exit if you were long and were trapped right here. If you didn't take that, and you had to pretty much sell at the open, because as soon as the stock opened, it pretty much just sold off. And that was people exiting that trade, basically. That was the bulls exiting. And all we've done is continued to sell off. So going back to the SPY, same thing. Here is your kind of your greed pattern, where you have people that are complacent. They think the market's going up. A lot of the time, they don't have any reasoning behind it. It's emotional, okay? You have to understand that, most traders, most people involved in the stock market don't analyze the stock market from a scientific perspective. They don't analyze the market using data, using technical indicators, and really try to read what candlesticks and all the fine little details of the stock market. They don't do that. Most people, what they do is they'll wake up, they'll check their, they check their stock, they'll check the, CNBC or something, look at the indices, and they'll see that they're up, they'll be happy, they'll look at their stocks, see that they're up, they're happy, and that's it. It's as far as it goes. When price moves up, they're happy, they get greedy, they're happy. When price moves down, they're sad, they're fearful, and they're not really able to anticipate why the move's going to go down or when it will go down. What they really do is they just wait for the headlines. They wait for the news channels to come out and tell them why the market went down. Most of the time, if you're a technician and you're looking at charts, you'll see the move well in advance of any headline, and that headline's completely BS, but they just tag a headline onto the move. Most of the time, a lot of the time at least, the moves that are created in the market are technically induced. And so it's algorithms which control about 80% of trading. They use math and science. They read the technicals. They make a play. They sell, and then the media comes out and tags a headline on it to keep the mainstream, complacent, I would say, because one thing that people fear the most is not knowing the unknown, I guess. So if they know why the market sold off, then they feel more comfortable, I guess, even though it sold off. I don't know the reality. But the point is, I'm trying to point out that most people, the masses, they don't see these bearish rising wedges. All they see is prices moving higher. They see this, all right? They see prices moving higher. They don't look at volume. They don't look at RSI or PPO. They don't look at any of that. So, when I point these things out, and when I'm looking at these charts, I really try to analyze what these candles are telling me about the potential future and the probabilities of the next move. All right, so that is the SPY. And we had a bull trap, and the trap was sprung, I guess, with a gap down and an impulsive sell-off. All right, so that is confirmation. That's about as good as it gets. You can't get much better when saying that the prices are going lower than this kind of pattern. We have a big, huge bearish rising wedge, which is a bearish pattern. We have a breakout to the upside, which set the bull trap, which was a gap. We gapped up here. This was the jobs report right here, by the way. So when they came out with that phony jobs report, this is it. All right. So you had a gap higher, shaking out anybody who was bearish. Anybody who was, and everybody who was bullish probably was piling on, and then followed by a breakdown of the bearish pattern, which came with the gap, which sprung the bull trap and created an island top reversal, an island cluster top reversal pattern. So Google island cluster top reversal if you don't quite know what that is, but it's basically this pattern where you create where you have price or trading action separated by gaps on both sides. Gap here, and they come at the end of an extended bull or bear run. So if this is a bull run and it comes at the end of the extended bull run, and that's the reversal pattern. If it was falling and you saw it kind of flipped in reverse, that would be a reversal pattern to the upside. So if I saw this after a big crash, I would want to be bullish. But this comes at the end of a top. So this sets the top, sell off here, and then we've got confirming price action the following day. Here's your gap up right here. We gapped up, and you can see I don't have it marked out, but this is resistance right here at 309. It's about 310, I guess. But we gapped up, and we instantly sold off. So the gap in the morning was instantly sold off. They tried to recover it at the end of the day in the last hour, and they were able to keep it kind of above certain levels, but still not much of a recovery. I mean, the bullish action that we had only regained just a slight amount of what was just lost in the week. So very, very bearish. It doesn't get any better than this, is basically what I'm saying on this chart. Now, we can't just look at this chart. We have to look at some other charts to understand potential outcomes. So, you can't just focus in on one chart, but this chart in general is pretty bearish for the bigger picture stuff. It's bearish for this pattern right here. The island top reversal tells me that this pattern was just reversed. And now we come down, and we got to wait, now we'll just continue to sell off until we see some sort of bullish reversal pattern. We'll start to see positive divergences in the PPO and the RSI. We'll see reversal candlesticks. We'll see something that will tell us that the bottom is in. But this is not in. Nothing tells me right here that this was the bottom this week. This tells me that this is just getting started. So I think we're definitely coming down, in my opinion. Let's look at some other charts. Oh, actually, real quick, I want to point out what I'm seeing here. Let me find this. All right, so here's some horizontal lines. I found this. My friend showed me how to do this tool. Again, I'm not an expert at the charting platform. I just am able to read these charts. And basically, here's what we got. We got 356 as support. All right, I get the support. You can see it comes in. See it come in right there. Tagged it right there. It held the support. When we sold off, we tagged it. We stopped short right there. Again, another reaction. We undercut it just slightly, but yesterday or Friday, they were able to still hold support. So the point is, SPY held support at this 350 level. What I decided to do, hopefully I don't regret it, but I decided to close my short that I entered I used triple Qs to do it, but I closed my short because the SPY was holding support, and I'm gonna wait. I want to wait for either a back test. So if this thing wants to back test, here's how you trade these island top clusters. This is the way you do it. When you have an island top reversal pattern, what they'll do, or what they'll try to do a lot of the times, is it's such a clean, easy pattern to see that you'll get a bunch of shorts like myself jumping in right here, and they will try to wash out all these shorts that took this initial pattern in the beginning. And they try to get them guessing if they're wrong. So what they'll do, a lot of the times, not always, but what they'll do is they'll run this thing up into the gap, and they'll oftentimes try to fill this gap. They might even try to run it all the way up here and fill this gap right here. So what I like to do is set my stop just above the gap right in here. So in this scenario, if I was trading this, I'd probably set my stop around 320, somewhere right in there, 320, 321. If you're doing kind of a trend trade and thinking this is the next leg of the bear market, you could even set your stop above the all-time high, 323, something like that. If we were to break above that, you'd stop out. So yeah, that could be a pretty big loss. But again, you took the short right here, so that would be above the all-time high. Let's say a 4% potential loss. You have a 4% potential loss, and you have You know, I mean, if this is the next bear market leg down, you can just hold this and ride it down. And eventually we would undercut these lows because, again, bear market, you're going to undercut these lows most likely. And, you know, so huge gain potential, 4% loss, that's your risk. And your reward, maybe from this level right here, let's just say you target a double bottom. You've got a 30% downside. So it doesn't get much better than that. You know, I mean, that is almost a 7, you know, it's about a 7.5 to 1 risk reward ratio. So that's pretty good. So that's how you trade these things. You know, how I prefer to do it is set your stop depending on kind of what you're anticipating. If you're just trying to get a, you know, kind of a short trade, you know, and not capture a big, huge trend move, then maybe you want to have a tighter stop. But if you're looking for the big move, then you could set your stop up here and then just ride it out, you know. But what I decided to do, because we held this support right here at 350, I'm going to probably try to re-enter if we get a pop back up somewhere. If we get a pop up to this gap, I'll look at starting the short again. And again, I have to watch the price action. If it's really weak, if any kind of gap, you know, moves higher are just sold into, then, you know, I'll have to judge that at the time. So the way I'm looking to trade it is add back the short, probably at gap entry. Maybe we start to get gap fill, look at adding some there. Or if we break below this 300. And so I'm watching for that. The reason why I don't necessarily think we're going to just continue selling off comes to the Qs. So this is the tech sector. The tech sector has 20% weighting in the S&P 500, and it's the FANG stocks, basically. So, because they make up 40% of this triple Q. So the reason why that gave me pause on continued selling next week, maybe we do get that move a little higher to wash out the initial shorts, is the Qs held support as well. So we've got SPY and Qs holding support. Here's your uptrend line on Qs that I've got marked out. Reaction. It's not, there's two uptrend lines I could draw. I could move this in right here and say we have lots of reactions right in here. We've got one there. We've got one here. Undercut a little bit, one there. So that's clean, and that would still have a recovery. But what I wanted to do is do the benefit of the doubt trend line. So I moved it down. It's not, we don't have as many reactions, but it's close enough to that other one that has a lot of reactions that it kind of gives me that margin of safety. So I'm going to have it here. We got a reaction, and then a reaction, and we recovered it. So I'd want to see a break of this to confirm the, you know, selling. So I'm hoping, well, I hate the word hoping. I take that back. That's one of my least favorite words when it comes to talking about the stock market. What I'm waiting for, I suppose, is continued signals of the downturn. But the way I'll probably play this is if we get the kickback rally into the gap, I'll start establishing the short, reestablishing it again with a stop up here, looking for the bigger trend move down. And I'm anticipating, I guess is the word, that we don't get some sort of a gap down breakdown. All right, that's possible because if the selling's going to start, it could start, you know, with a fury. I mean, it already has, but it could continue and not give people an opportunity to get great short positions by gapping down. However, because this island top is so cleanly seen, I mean, I've seen several YouTube charting technician guys. They all are calling out this island top. I was calling it out way up here saying, you know, this is probably a bull trap, and what would be very bearish would be a gap down below this wedge. I said that in the past video, and that's exactly what we got. But now it's a very clean chart pattern, so I think that a lot of people are short that are watching the charts, and a good way to kind of wash those people out or trick them would be to run it back up into the gap. So I'm looking at that. That might be a good opportunity to reestablish a good short. So last week was very profitable for the bears. Lots of trades worked. Here's Walmart. I said in a comment, and one thing I want to point out is if you sometimes I can't put out videos or things that I'm seeing quick enough. So I'll just comment in the last video that I put out about what I'm seeing. So I put out in a comment on the last video that I made about Walmart, how the price action continues to be bearish. It's breaking down. We now broke this support right here at this 20, or it was about 121, right in there, and we held that for quite a while. I mean, we're holding that for about 43 days, so quite a while. And I shorted right here, right before the gap down, and you know, I've been riding this whole thing out. I rode this big ramp up out, but once I saw this earnings pop and sell off, I felt pretty confident that this was bearish because they sold that off. They had an opportunity to run it higher and it failed. So closing back below resistance. So I was just waiting for the breakdown. We just started to get it. So here's your your bear break right here. This should continue now and easily get down here to the bottom of the wedge. Depending on when we actually get there, this is a daily chart. You know, if we get that, let's say we get down there in a couple weeks, or let's say we get down there in a week. Sometimes these things can run quick. That's a 10% drop to go. So I'm waiting for that. That's kind of the trade at this point, is to let that thing fall down there. And then it is a bigger pattern, a bigger bearish pattern. So this might want to break down even more. And what I'll probably do, I've said repeatedly, is take some profit down here at the bottom of the wedge. And then I'll probably wait and see what it wants to do if it wants to break. It might bounce off of this wedge up a little bit and then eventually break the wedge and start to run lower. So I have to watch that. TVIX. Lots of people are interested in TVIX because it had a huge monster day. And the point that I want to make is, and this is something I was saying in some of my last videos, the market continued to run higher. When I pulled my last short, like let's say Qs, I pulled my last short and I said, look, this thing could continue to run higher. I'm not going to jump on board long. I don't FOMO. I don't feel any emotion when I'm missing a trade, essentially. Unless it's a trade, I guess, that I have really been anticipating and I somehow got shaken out of it and then the trade works out. That's really frustrating. But this trade, I've been bearish. I've been looking for this is a bear market rally. And I just told everyone, look, this thing could continue to run higher. I'm not getting long. I'm not going to FOMO. And that was because I don't chase trades. And that's the same with TVIX. Here's TVIX. This thing ran up 70%, I think, from down here. And, you know, I didn't capture any of that. You know, I actually did own some TVIX right down in here. But we started to break down. They kind of shook me out a little bit. And I didn't own a lot. But what I was looking for with TVIX was to buy it back at the support line. So here's your trend line in TVIX right there. You can see lots of reactions. And I was looking to see a recovery of the trend line after failing, recover up, maybe come down, tag it again. And that's where I'd start to buy some TVIX. But I didn't get that opportunity. It gapped and ran. At that point, I just let that one go. But that's okay because, you know, TVIX for me is like icing on the cake. I don't take out huge positions in it. What I do is when I'm looking for a breakdown or an inflection point in the stock market like this reversal that just took place, that's when I'm looking to, you know, buy TVIX right before the reversal when I see the probabilities increase that a reversal will happen. And then when you get when the reversal happens, if it actually happens, and you get the huge spike in TVIX, I sell my TVIX on those moves, and I take the profit, and then that allows me to continue to hold the longer swing shorts while still taking some profit in case I'm wrong on the swing shorts. I'm able to capture and lock in some profit on that, at least that initial move. So that's how I trade TVIX. I don't hold this thing for very long. You know, sometimes I can hold it for a week or two, depending on the patterns that I'm seeing. But I don't. It's not a long-term hold, and it's also TVIX is not guaranteed to just continue going up if the market continues going down. TVIX moves higher when the market has drastic impulsive moves. If the market just slides lower, not not a complete crash, but just continues to move lower like a bear market potentially will, then TVIX could actually move down as the market is moving down as well. So TVIX is like a shock troop. You use it as that first initial blast and then exit. So the lesson that I want to kind of point out is don't chase. All right. I know it's hard to not, but again, when you're using, just use, if you can use charts, what I do to help me control my emotions, this is just a lesson I've learned, but to help me control my emotions, what I do is rather than focusing on the 1 minute chart and the stocks like right there and maybe how much money you're making or how much money you're losing, you're looking at your account or whatever, rather than do that, that is how you churn up your emotions, and that will get you to jump into trades or exit. It triggers something in your hippocampus or whatever, medulla oblongata or whatever it is, to for that emotional fight or flight response, I guess. What I like to do to help me control that is I always am rechecking, and I'm constantly checking my charts. All the charts I look at, I'm constantly going in, looking, okay, is the thesis that I'm trading against still plausible? Is it valid? It is? Okay, then I'm okay. And I'm looking at, okay, is tech still good? Is the S&P 500, has anything technically changed recently? No, it hasn't? Okay, then I'm still good. When I start to see things that have technically changed and I start to see, oh, okay, now this doesn't look the same as what it's looked in the past, then I can, either exit my trade or whatever. And that's why, like the Q short, I started getting out of it earlier I got out because I saw things changing. I saw the market flipping into this euphoric, complete bullish mode. And with everything was telling me that. And so I figured, okay, I don't know how high this thing can ramp up. It's clearly wanting to ramp up. I don't know how high. So I'll just sit on the sidelines and wait, let the ramp happen. And then when the reversal signal comes, I'll get back in. And that's exactly what I did. So got back in right here, rode this completely down, and then exited right down here near the lows. And we'll see what comes next week. I'm looking for another entry on the short side. I am definitely bearish on these patterns that I'm seeing, but we could have a move higher, and that will, for me at least, provide a good opportunity to reestablish some good swing shorts. So that is it, basically. When the sell-offs come, they come with a fury. The sell-off that we had last week, given the close, we wiped out, about 10 days. It's, depending on where you mark it, but let's just say about 10 days worth of gains right there in the triple Qs. And in the SPY, I think the damage was a little bit worse. We wiped out about, going back, you could say, depending on if you entered here, 11 days or, price action going back 15 days, something right in there. So, that happened in, that basically happened in 1 day right here. You wiped out a week and a half, 2 weeks worth of trading. 15 days would have been 3 weeks. So you anywhere from 3 to 1.5 weeks worth of trading, you wipe that out in 1 day. And that's going back to the other point that I try to make for all the trolls out there that like to troll me when markets are moving higher, is the fact that I continue to say, look, markets will move up 80% of the time and they move down 20% of the time. But when they move down often, and especially in the beginning, they'll move down and wipe out that whole 80% of gains. They'll wipe that out in 1 day. And so that's just what I'm saying is now, we grind higher for a little bit and then we have another impulsive move down. We'll wipe out a bunch of gains. That's kind of how it works. So we'll watch for this. We'll see if we want to run higher and then, start the selling. The bear market, if this is going to be a bear market, it's most likely, in this area, you still have a lot of dip buyers. You still have a lot of people that think the rally's still good. So they're going to come in and try to buy the dip, and that's what you saw. They're buying the dip. Maybe we run a little higher. They're going to think that it's not over because they don't recognize the pattern. And that's what, they see this again. So they just think this is a dip, a buy the dip opportunity. And maybe it is. Again, I don't know. I only can read the charts and my interpretation of them. But so that's maybe what you'll see. And then you'll see a move lower. And then there will come the point where where the bulls realize that it is, that the rally is over. And then they start to panic sell and exit in hordes. And that's when you see that next big thrust down, where it just, really moves down impulsively. And then we start looking for, a rally, a little bit of a rally. And that's the name of the game, guys. So thanks for following along. Leave me a thumbs up. Just wanted to kind of talk concepts here and point out some of the bigger picture charts. And leave a comment below of any stock you'd like me to look at. I try to get to some of them. I can't get to all of them, but I do try to cover some of them, and I have put those in the videos. So leave a comment below if you have a stock you're interested in. I can't say all the hype stocks like Nikola, Hertz, all that stuff. I'm just going to tell you stay away. I mean, that's just my opinion. I don't really need to look at the charts to know that a pump stock is going to come down if it's pumped. And that goes back to the other concept. I don't chase. So if something's ramped up high, I just let it run, and that's that. So again, leave a comment and leave me a thumbs up. Appreciate that. Catch you guys on Monday, and we'll take it